Hi, everyone. Welcome to Your Money Matters. I am Angela Giroux, publisher of the Bauman Letter, and joining me are Ted Bauman and Clint Lee. If you haven't already, I highly recommend you check out Ted's latest presentation called The Final Bull Market. There's a link above and below. It's really the perfect complement to the discussion that we're going to have today. So fellas, this year's big theme in the stock market has been that there is no theme, right? The market is up one day, down the next day. Ted, you've talked about before how this is really being driven, the stock market is being driven by external factors, COVID, the Fed. It's not a fundamentally driven stock market, which I can tell you personally makes it much more difficult to navigate. So Ted, how can we make sense of what's going on in light of all of this? Because it does make it very hard to predict the market's next move through the end of the year.
Yeah, no, it certainly does. And I think one of the ways to look at it is that in a way it is a fundamentally driven market. It's just that the fundamentals themselves are driven by these external factors and nobody knows how they're going to affect them. I mean, I was just reading now something about COVID, the Delta variant, and things are looking a lot scarier than they were just a week ago in terms of the transmissibility and the lethality and the potential. That is affecting fundamentals because it calls into questions rosy earnings projections. So, in a perverse way, it is driven by fundamentals, but not by actual numbers. It's like what might happen to the numbers. So here's something that Clint sent to me actually this morning, which I thought was very useful. It's a sort of a way that a Bank of America analysis has categorized the economy since late last year. The first stage, we saw a reopening rally, which started in about November, that lasted until about mid-February. And that was really based on optimism from the elections, a united Democratic control of Washington, which meant spending. And then, of course, the vaccine rollout. So stocks went up, the yield curve steepened, the dollar weakened, defensive stocks went down, and cyclicals went up, all the stocks that you would expect to do well when the economy rebounds. Then there came the inflation scare, which was kind of like overdoing the first phase. And that lasted until from about mid-February to mid-June. And that was based on really high retail sales, which was obviously based on reopening, number one, and number two, the stimulus payments. So commodities went up, yields went up on long-dated bonds because people thought inflation would come. That pushed tech and growth stocks down, and then value stocks began to outperform. Then from mid-June, we've seen kind of a uncertainty on the part of the Fed. Are they or aren't they? They really should be thinking in dovish terms now, because if Delta is this bad, then they're not going to be raising rates. But we've also seen relatively strong growth outcomes in China, which suggests that the global economy could do well. So it's all mixed up. So then now the yield curve has collapsed, bonds have rallied, the dollar is up, and defensives are doing well. So you've basically had three different versions of stock market direction in less than a year. Now, what comes next? Well, the next depends on COVID, really. I mean, it depends on what happens. Unfortunately, it looks like you can get COVID even if you're fully vaccinated now. Which means that you're looking at lockdowns, you're looking at masks, which means you're looking at more conflict. So that's the one thing. The other thing is Congress and what happens with an infrastructure bill. So I put together a chart that really shows all of this happening, but there's a key thing in there, and that's one group of stocks that has done well right throughout. This chart shows really a couple of things. It shows the Russell 2000, which is really a proxy, I guess you could say, for cyclicals, basically GDP-oriented stocks, and it's been trading sideways since really February. When we ended that second cycle, the so-called inflation boom. Then I've used SPAK, which is an ETF that covers the SPAC sector, the special purpose acquisition companies, just to show how sentiment has turned away from last year's, darling growth stocks. But look what's going up. Those two that have the rising yellow arrow. One is a quality ETF that focuses on quality companies with good earnings, companies with robust markets that don't go up and down depending on COVID and things like that. And also and an international one as well, IQLT. So look at those two. They're both steadily rising. So my guess, and Clint can confirm, what he thinks. I think that's where you want to be right now, because the uncertainty is not going to resurrect SPACs and growth stocks. I don't think that's going to happen right now, even with very low interest rates. And it's also not necessarily going to resurrect cyclicals. So we just don't know. So right now, quality rules, and that's what people should be buying. But we'll see what Clint has to say.
Well, Clint, I actually have a question for you because, going back to what Ted has been saying, we are still in a secular bull market. Now, that's tough to reconcile with the fact that stocks are just going up and down and up and down. So how do you reconcile that?
Just to clarify first, I mean, when you talk about a secular bull market, that's what we're talking about, just a period of long-term sustained gains. And I think what's amazing is, Ted outlined the different market environments we've seen just this year, and we have not even encountered a 5% pullback yet. So just with, there's been a lot of churn underneath the hood, but at the index level, at least for the S&P 500, we still have yet to see a 5% peak to trough pullback in the market. And that's more, this straight up, especially since November, is abnormal. Seeing those corrections, those pullbacks, even during a bull market, that's normal. And just to show you an example, here's a chart of the S&P 500 during the absolutely epic bull market run during the 1990s. And you had numerous pullbacks and corrections on here. A lot of times Wall Street likes to define a pullback as 5% to 10%, and a correction being a 10% to 20%. Once you get beyond 20%, that's the bear market definition. But you can see even during the 1990s, you had numerous pullbacks and correction. You even had in 1998 a 16% peak to trough decline in the market. But if you got shook out of the market in this instance, or any of these others on here, you've missed some pretty incredible gains ahead. And so you had this longer term uptrend in the market. And that's what we mean by that secular bull market definition. And just to show you how common like a 5% pullback would be, here's a couple charts from LPL that they put together. So this shows the number of 5% pullbacks per year going back to 1950. So if you look kind of back historically, you'll see that there were 6 years out of 70 that we didn't see any 5% pullbacks. But when you start to average these together, what you see is that since that time, we average about 5% pullbacks a year. So once again, just highlighting that, everyone's kind of captured by the fear of seeing stocks go down, but it's normal, even during a bull market. It happens. And there's another reason we should expect to see some choppiness in the markets here. That's because just when you start to progress through year two of a bull market like we are now, going back to March 2020 was the start of this new bull market. When you start to get into year two territory, things start to get a lot more choppy. And here's another chart from LPL to illustrate that point. This yellow line that stops about midway through, that's the current bull market that we're in now. But this plots it out against a couple other different bull market scenario or past bull markets. So one that started in 1982, that started in 2002, and then March 2009. Just what you can see is that as you start to progress through year two, we're kind of hitting that period where you start to see some downside, some choppiness, some sideways trading. So once again, just reiterating the point that what we've seen here recently is definitely not out of the ordinary. It should be expected. And so how can we prepare for that? Ted was mentioning just the quality ETFs earlier. Just to piggyback off of that, I do think quality factors is a good place to be right now. When we talk about quality, what do we mean by that? That's healthy balance sheets, strong profitability, things like return on equity. And also, frequently companies that have moats. We talk about moats. They have some sort of durable competitive advantage that allows them to generate these high returns. But quality is incredibly cheap right now. So here's a chart that shows the highest quality stocks in the Russell 1000, their valuation relative to the index itself. And this goes all the way back to 2000. What you can see is that this line, this relative valuation, is at its lowest since 2000. So quality stocks are at their cheapest levels relative to the index in about 20 years. So quality is one place to be. Ted also mentioned on sort of the international side, that's an area where we can focus on as well, because we know valuations are expensive right now. I mean, we've talked about cyclically adjusted PE ratios in the U.S. It's a reminder, the CAPE for the U.S., wrote this down, is at 38 right now, versus if you look at Europe and Japan, they're both at 24. So international markets, it's another place to look just with how cheap they are, but we're starting to see more earnings growth here as well. And then this is my last chart, I promise. This shows U.S. companies, ones that are more export oriented versus ones that are more domestically focused in their relative earnings growth. So when this number is on this bar chart is positive, that means U.S. exporters are seeing faster earnings growth, and then vice versa. When it's below zero, that means companies that are focused more on the domestic economy, their earnings are growing faster. This goes back to 2016, but if you look more recently, you can see throughout 2019, 2020 in particular, U.S. domestically focused companies were seeing a faster pace of earnings growth, but recently that's been turning around. So what that means is that you're seeing stronger demand from international regions. So I think that shows, not only is international cheaper, but it's in the early innings of seeing an earnings rebound as indicated by this chart. So those are two areas, expect a pullback, expect choppiness. These are two areas where you can hide out at.
And I have a question on that chart. Does exporters include, is that just, physical exporters, or does that include multinationals who have operations offshore?
I assume this includes multinationals that have operations offshore. Yeah.
Mm-hmm. Right. So what's amazing is that that's happening even with a strong dollar. I mean, that just makes it even more incredible, because you would expect the opposite. So that tells you something.
Great point. So you mentioned the quality company ETF, and as we've mentioned before in these videos, those ETFs are sometimes, if you want a more specific way to play it, you can sort of dig into those ETFs and see what their holdings are. But are there any other ways to maybe play what we're seeing ahead?
Well, the two ETFs that I suggested were IQLT, which is an international quality. It focuses on companies both in the US and international, and then QUS, which is focused on US quality companies. And so, again, I would say those are two good plays, but it's always a good idea to go to somewhere like Yahoo Finance and then look at the tab that says holdings and see which companies are on there and see if you see any that you like. So just to reiterate what Clint said, quality means strong balance sheets, good profitability. It means good. They're in a market that is resilient. It's not the latest flashy widget that they're selling. They're selling stuff that people need. So that's one place to look. But there's another place, and that is right here in the Bauman Letter. This is a chart that shows our time-weighted rate of return since the beginning of the year against the Russell 2000, which is basically, like I said, a proxy for the broad stock market, excluding a lot of very, very micro caps, but also excluding some of the companies that have been more volatile. And we're just beating the pants off it this year. And one of the reasons for that is because we focus very strongly on high dividends. With the exception of a couple of outliers, we have most of our companies are in excess of 5% annual dividends. You compound those through a period like this, particularly if they are real estate investment trusts that again, real estate is just robust. I mentioned VNQ, another ETF, I think last week, and that's where you're getting growth. If you go back to that chart I showed earlier, it shows that that steady upward line that's reflected in practice in our own portfolio. So that's another place to look.
All right. Well, again, for those of you watching, please make sure you check out the Final Bull Market, and you also find our details within that presentation of how you could join us at the Bauman Letter. And like Ted said, our endless income right now is really, really outperforming. So please make sure you check it out. Ted and Clint, thank you so much. I'll see you next week.
Take care, guys.
Thanks.